Morning, everybody. Thank you for joining us. We're going to walk you through the changes that have taken place certainly last week and throughout the program from our initial webinar as it affects your ability to obtain loan forgiveness, which of course is the desired result for everyone. A couple of observations. In the first instance, I suspect everyone's hair is a lot longer, including mine, so I apologize for that. No one can find my barber. With respect to the Paycheck Protection Program, the PPP loan, then we now have the PPP Flexibility Act, and we're going to refer throughout this webinar to the Flexibility Act to differentiate it from the PPP loan. Colin and Chrissy and I will be talking this morning about various subjects, and we'll be walking you through the items as we feel they best affect or impact your ability to obtain a loan forgiveness. If your bank officer is still talking to you after this period since March 27th, that means you haven't been too annoying and they are on your side. Remember, your bank officer is the one who's charged under the Act with determining your forgiveness. Since the initial application process of the SBA, and it has now been reiterated that subject to $2 million or more in a loan, you will be audited by the IRS and or the SBA at some time in the future. The new Act makes significant changes concerning various calculus that were anticipated in the initial Act, but have been clarified, modified, or changed completely by the Flexibility Act. At this time, we'll have Colin is jumping in.
Yes.
Okay.
You can go to the first slide. All right, so how did we get here? As Jim just mentioned, the CARES Act was signed into law on March 27, 2020 in response to a unprecedented pandemic of COVID-19. On May 15, 2020, the SBA released the PPP loan forgiveness application instructions. And on May 28, 2020, the Flexibility Act was passed by the House. It was then followed on June 3, 2020 with the Senate passing it. It was then signed by the President. Since the passing of the original CARES Act, there's been a lot of questions, a lot of confusion. We've had regulations, interim rulemaking by the SBA that has been at times helpful and at times confusing, at times seemingly challenging to the original intent of the CARES Act. Our read is that the Flexibility Act has pretty much has positively improved a lot of aspects of the original PPP, especially in regard to forgiveness. So we've done our best to address how it will affect forgiveness, with the caveat that there is likely still to be some interim rulemaking by the SBA that may come about. Certainly, it looks to us that there will be necessary modifications to the current interim rules. We've tried to roll that into this presentation so that you can have the best advice we can give you at this time. Next slide. So here are some important updates and things to remember with regard to loan forgiveness. As an initial matter, the covered period, which initially was 8 weeks, beginning at the date of loan origination, i.e. the date of disbursement of loan funds to you, has now been shifted to 24 weeks or on no later than December 31, 2020, whichever is earlier. This is a broad expansion of the period in which you will have to use the loan proceeds from the PPP. The original period met with fairly significant criticism because of when combined with the regulatory requirement at the time, which was that there would be a 75-25 split use of the loan proceeds, with 75% towards payroll costs, it was something that where some employers were unable to spend the money in that time effectively. So this has been generally hailed as a positive thing. This enhancement does allow you still, if you receive the loan before June 3, 2020, you can still elect to use the 8-week period if you prefer. But again, there's nothing, you could also use a 9-week period or a 10-week period. We'll be talking more about it throughout this presentation, but part of maximizing forgiveness is choosing the optimal time to seek forgiveness, and we'll be discussing that more as we go. Next. As Jim mentioned in his intro, the loans, the SBA has made it very clear that loans over $2 million will be audited. And crucially, there is a box to check on the present iteration of the application if your loan is $2 million or more. If you have a loan of less than $2 million, make sure you don't check that box. I'm not suggesting anyone would do that, but there is a crucial distinction. Those with loans of $2 million or less are presumed to have been applied for in good faith, including the certification that it was necessary in light of the COVID-19 circumstances. So this is a big point to focus on, and please don't misconstrue what I am saying with regard to loans of $2 million or less, or I should say less than $2 million. You still need to be careful with how you hold the money, how you document your use of the money, and hang on to paperwork to the best extent you can, because even if you're not being audited formally, it's still best practices to be very careful with documentation relative to use of this government forgiven loan. Next. So, as I referenced before, when you apply for forgiveness is a crucial aspect of this. So you should apply for forgiveness when you are ready and meet all the necessary requirements. What does that mean? It means you've used the loan proceeds, you've eliminated your FTE reductions or reductions in wages of over 25%. Those are major elements that can impede your total forgiveness. Assuming everyone's goal is 100% forgiveness, and as you're going to hear in a few minutes, you're also going to need to make sure that you're using 60% of the loan now instead of the 75-25 I referenced before. 60% of the loan on payroll costs. That's a necessity in order to achieve forgiveness. So since the covered period has now been extended, your date of when you apply for forgiveness may now change. I assume many of you were early applicants for PPP loans, which means you're coming up to the end of your 8 weeks, which would be the original covered period. And so your calculus may have shifted. One thing you should be aware of is that under the Flexibility Act, you now have up to 10 months at the end, 10 months from December 31, 2020 to apply for forgiveness. So the period, the new covered period extends until December 31, and thereafter you have a significant amount of time to apply for forgiveness. I would suggest, however, that your time to apply is when you have met all of your requirements. You've used all the loan proceeds you're going to seek forgiveness on. You've eliminated those FTEs and wage reductions. You never know what's going to happen after you've met those, so you might as well apply for forgiveness once you meet those requirements. Next. Taxes, a crucial part of the forgiveness process. Positively, pursuant to the CARES Act's specific terms, loan forgiveness itself is not a taxable event. However, any expenses paid and forgiven are not tax deductible, even if they would have been otherwise. This is something you should consult with your accountant about and address this tax issue and to discuss favorability. But this was something that there's a question as to whether the IRS guidance on this, which has said that that use of PPP funds for otherwise tax deductible items eliminates the deductibility. That opinion has been controversial. It's been something that there's been a fairly significant cry to repair, and there's still ambiguity as to whether or not that was ever intended by the CARES Act drafters. However, it wasn't fixed by the Flexibility Act, and since it wasn't fixed, there's very little likelihood, I think, at this point, that you will see a congressional fix to that issue. So one other element you should be aware of is that as of the passing of the Flexibility Act, businesses who took PPP loans now have the ability to defer certain Social Security share of taxes under the CARES Act. Under the CARES Act, in a way that they weren't eligible before. The PPP loan used to preclude the deferment of those taxes, the employer share of those taxes. It's now permissible pursuant to the Flexibility Act. Next slide. Now, a crucial aspect of the PPP has always been the certification that was amplified in the headlines, number one, and in a lot of the public discussion around the loans and in the frequently asked questions issued by the SBA, that the certification that funds will be used to retain workers, maintain payroll, or make mortgage payments, lease payments, and utility payments. That's what these loans are for. As per the Flexibility Act now, 60%, you'll recall, as I mentioned, the SBA, through its regulations, created this 75-25 split, where 75 needed to be used for payroll costs, and then 25 could be used for other covered purposes. Then the Flexibility Act, after I think fairly substantial outcry about largely driven by the high cost of some of those other features, such as rent, shifted that. Well, first it enshrined it in the statute itself, and also shifted that percentage. So now it's 60% of the funds must be used for payroll costs. And we read the law as requiring that 60% be used for payroll costs in order to get any loan forgiveness. That's the most rational reading of the law at this point. Before, when it was 75-25, and it was a creature of pure regulation, it was something that was viewed as a sliding scale, where you could have your forgiveness reduced. Now we're reading the 60% must be used for a payroll cost in order to get any forgiveness. Keep your eyes on the SBA regulations. It's possible that they'll issue a regulation changing this, but as it's written and enshrined in the law, it says 60% of the funds shall be used for payroll costs, and we'll address that more later. Funds must be used on issues, payroll costs incurred and paid in the elected covered period. We highly recommend that you keep your funds in a separate account for easier accounting relative to the forgiveness application. It's just a cleaner, easier way to manage your process and thus not avoid confusion and easier forgiveness. Next. Again, just a reminder, with any payroll costs, they must have been paid and incurred in a 24-week period now. Again, that 24-week covered period is going to ease your ability to utilize, to meet that 60% threshold. And it should make it substantially easier for you to obtain forgiveness. Next slide. So for employees that are non-owners and non-partners, you can include in payroll costs, the definition of payroll cost includes regular payroll, hazard or incentive cash compensation, tips, vacation, parental, family, medical, or sick leave, or dismissal and separation payments. Remember, it's up to $100,000 annualized per employee, which is roughly $15,000. This excludes the clearest exclusions are for payroll that that you received a credit under the FFCRA, the Family First Coronavirus Response Act, or the Emergency Paid Sick Leave Act, which provide coronavirus-related leave that is also funded through payroll tax withholding by the employer. So that's to preclude sort of the double dipping angle. Next.
Colin, before we
Yes.
move on to the next slide, we got a question that I actually think would be helpful to address as well in this section. Does payroll just mean employees, or can it include contractors or subcontractors?
Right now, the interim rule is very clear that contractors are to be excluded from the payroll costs, because payments to because theoretically contractors and subcontractors could apply for the PPP loan themselves. That's the rationale. That was set forth in the early interim rulemaking by the SBA. Employees that are non-owners, non-partners, just continuing, there are additional items that can exceed that $100,000 prorated threshold, which is employer contributions for group healthcare benefits, employer contributions for retirement plans, as well as employer state and local payroll taxes. Next slide. So this next slide sets forth how payroll costs should be dealt with regard to partners, owner, employees, and self-employed. Now, this is an area that remains very much in flux, in my opinion, largely because this was a part of the forgiveness rulemaking that almost immediately predated the Flexibility Act. So this was issued, I believe it was within a week of the Flexibility Act being passed. So it's not clear exactly how this will be impacted by the Flexibility Act, but the interim guidance was that for partners, they should use the Form K1 box 14A, net earnings from self-employment income multiplied by 0.9235, and limit that to the lesser of 8 weeks worth of 2019 K1 or 15,385. Then these interim regulations set forth this concept that owner employees, and that's the term of art they chose to use, were limited to the lesser of 8 weeks worth of 2019 annual compensation or 15,385 across all businesses, meaning, as I interpreted that, and we interpreted that, if you have multiple businesses with PPP loans for each business, you would be capped at 15,385 across all of those businesses in terms of income. And similarly, self-employed individuals will be limited to 8 weeks worth of 2019 Schedule C earnings reported on line 31, with a limit of, again, 15,385, which is the annualized 8 weeks worth of $100,000. So it's, again, that $100,000 cap. That's where that 15,000, it's 15,385 comes from. So what we don't know now is how much this is going to stand in light of the shift to the covered period, because the 8 weeks referenced here was conceptually attached to the covered period of 8 weeks. Now, the question we have is whether or not the sum will change based on the recent extension to 24 weeks. So will the 8 weeks and 15,385 number stand? We don't know. It could be that it's extended up to 46,155, which would be the annualized $100,000, or it's possible that it will remain the same or otherwise change in some other way. We anticipate that that conceptually this will remain intact, these interim regulations. It's just, I think most likely to change, if anything's going to change, are the numbers associated with this. And remember, the loan amount isn't going to change, so it's still 2.5 times your average month. So it's possible that the 15,000 here will remain the same. Next slide. So the other uses you can use for the funds, and again, this is not to exceed, if you want full forgiveness, you can't exceed 40% use of loan proceeds for these items. Mortgage interest payments, rent and lease payments, utility payments, interest payments on other debt incurred, and financing an EIDL loan, the Economic Injury Disaster Loan. And again, all these have to have begun before February 15, 2020. And they have to be incurred and paid during the covered period. So the covered period now being as it is, extending to December 31, 2020, really leaves you quite a bit of flexibility. But again, you don't want to exceed that 40% threshold if you want forgiveness of any part of the loans. Next slide.
Hang on a second, Colin.
Go ahead.
There's a question that came up. Can you use the PPP funds as a part of your rent payment for CAM charges? I would take the position that if the lease provides, and many of them do, most of them do, that CAM charges, when presented to you, constitute additional rent, that in fact you could use them in the calculation, but you're going to need, I would think, to look at your specific lease document to see whether or not that or similar language is included.
All right. Next slide.
This is actually my section. But before we move on to this section, Colin, the other two questions I'd just like to zoom in on to are why do you think that they're asking about grant money and the EIDL loan on the application forms and, for things you can use the money for? Do you have any thoughts about that?
Sorry, could you reread that again?
Sure. So why on the form, or just generally, as we've known from the beginning, they've kind of asked about grant money, which I believe this person means the grant money they got from the EIDL loan application in the beginning and the EIDL loan in general. Do you know why they are asking about those things?
Oh, yes. If you've gotten certain EIDL loans, you may or may not be eligible for if you got an EIDL loan and other than refinancing it, you're not PPP eligible. However, if you got the grant, the $10,000 grant, that just comes out of your forgiveness sum. That's deducted from the forgiveness sum. I believe that's the answer to that question.
Yes, I would also say that would likely make sense. If you spend all of your funds that you got on payroll loan, do you need to concern yourself with those other qualified expenses?
No, and in fact, it seems it's never been easier to do that thanks to the 24 weeks. So no, the short answer is no.
All right. Do you think that you can use, either Jim or Colin, can you use the funds for floor plan expense?
No. No, the reason you can't is because you have your floor plan borrowing instrument actually applies interest to each individual vehicle as it comes in and goes out of inventory. So based upon that, you're not going to be able to capture the collective interest. It's not a mortgage payment, it's certainly not a lease payment, but it's an individual, a floor plan loan obligation applies to each individual vehicle in terms of calculating interest. So you're not going to be able to deduct.
All right. Do we think, Colin, that you can use our health insurance premiums for the employer part of the 40%?
No, for the employer, I would think not. I would think that would fall within payroll costs.
We talked about earlier, Chrissy, you and Colin and I, the issue of what's captured, what's paid, and versus what's incurred within the applicable period. And I don't know if you want to go into that now.
Sure. So
the issue yeah, go ahead, sorry.
I was going to say, so a question we got, so we can all talk about this one way or another, is for payroll cost, is it paid and incurred or paid or incurred? And why? And I know there's just some discrepancy between regulations and the law and all of that, but what can you use the proceeds for? Are obviously things paid out at that time period, do they have to be incurred during the covered period that you picked?
Let me kick around some ideas before you jump in, Colin. Specifically talking about a 401k plan. Most of you typically have your employer portion of the 401k contribution pulled from your account immediately prior to the filing of your annual corporate income tax return. If you're filing on extension, for instance, that would be September 15th. Many people have their funds pulled on September 14th. In fact, those are obligations that relate to 2019, but they're paid in 2020. If you pay those during the period, the original 8 weeks, now the 24 weeks, within which the calculus is to be determined for forgiveness, are they included? It's not an obligation that was incurred during this period. It was incurred last year, and yet it obviously has to be paid this year because it wasn't calculated until this year. Then you can drift on to the issue of what can you deduct if you're short of payroll expenses in order to reach the 60% forgivability floor that you have to reach. Can you deduct the expenses associated with your 401k for the year to date that you calculate during your period? The answer probably is you should be able to do it. The question is, will you be able to do it? Because most 401k plans provide that the calculus is done for employee contribution attribution is done at the end of the year when the full payroll is known. So if you want to obtain your deductibility and file for it on June 30th, you obviously don't know what the individual employee's compensation would be at the end of the year. So therefore, your plan does not allow for interim payments. So those would appear, unless you have a unique plan, not to be includable for the current year. So you're going to have to deal with your accountant on those very specific issues as to what's an attribute of a payroll and what's not, and what you can capture and what you can't. Sorry, there's no easy answer.
So one other question before moving on to the next section, for whomever, I guess I can start. To confirm, you cannot get both the Paycheck Protection Program and the Economic Injury Disaster loans. I think that there's a little bit of confusion just generally. You had to certify to apply for the Paycheck Protection Program that you were not going to, that you weren't going to get this loan for the same thing that you'd already gotten another loan for. So it seems to be a loophole that if you are using the two loans for separate things, you're not using it for the same payroll cost, other funds, etc., that maybe you could figure out how to get both of them. But I don't think their intention was for you to be able to get both of them. So I caution about having both of them. In fact, as part of the Paycheck Protection Program, as Colin had said, when you do forgiveness, your forgiveness is going to be reduced by that grant you got for the EIDL. And further, they wanted you had the capability when you applied for the PPP to refinance your EIDL as part of that overall sum of the loan you got. So I think that although you technically can have both, it's going to be some fancy footwork to make sure you can demonstrate that you're not using those funds for the same thing. So I would just be very cautious of that.
Chrissy, could I ask you clarification on that?
Sure.
Does your interpretation also include the $10,000 grant that prefaces the EIDL?
Okay, so the grant is definitely absolutely included. I don't think there's any gray area there. So for example, if you thought that you were going to get forgiveness because say you had a loan of 100K and you had done everything perfectly and you should get forgiveness of 100K, if you had also gotten an EIDL grant of 10K, they would reduce your forgiveness for the PPP. So they'd only forgive 90K of your 100K PPP loan because they had also given you that 10K grant. And that has not changed, and they have been explicitly clear about that. And that's why that still remains on forgiveness forms the way they are right now, because it was not their intention for you to get both the grant and complete loan forgiveness.
Thanks.
So they did not want you to double dip there. All right, I think that gets us a little bit up to date on our questions, so I will continue and move on to the next section. Just for the other people who were unaware of these capabilities, there is the capability to use the Q&A. There's a little, looks like a bubble in your menu bar. You can type your question there. Or you can type it in the chat window. We're trying to keep them both there. Some of these new questions coming in, hopefully I will address in this next section. So I will pause on them and we will come back to them after I get through this. So hold tight. All right. So there's a couple things we have to consider when we are considering our forgiveness. And obviously this is the most important piece by far, because this is what made this so appealing for everybody. Not only were you getting a loan that, if it stays a loan, has some good terms, but you were hopefully getting money that you didn't have to pay back. But there's three things that you have to keep in mind for your forgiveness. First, as Colin touched on, and I'll spend a little more time talking about, is the new 60-40 rule. If you fail to meet that 60-40 rule, you're going to have some problems with forgiveness. That's the payroll costs, the 60%, to your non-payroll costs, the 40%. There's a reduction in employee numbers. That's that fun full-time equivalent employee, the FTE that we've been talking about. That's what that is. That's the comparing of the two periods. And then there's the reduction in the employee pay as compared over two periods. So that's kind of our overview. And I'm going to step into the next slides to break that down for you a little bit more. Just as a heads up, after the conclusion of this webinar, we will forward these slides to you so you can refer back to them. So the 60/40 requirement, as far as we can tell, it appears to require that the borrower spend at least 60% of their loan proceeds on the payroll costs to be eligible for forgiveness. So there is no forgiveness, not a single penny, if you do not use at least 60% on the payroll cost. Now before, when the SBA had put out regulations after the CARES Act, it appeared to be a sliding scale when they did the 75-25, which meant that if you didn't hit your full 75% on payroll costs, that you could still get some forgiveness, but it would be reduced. Now it appears to be a very hard cliff, and that you have to use at least 60% on payroll costs. And if you don't, then you aren't eligible for forgiveness, period. Now, I put the exact language, as you can see in the second half of this slide, that was in the Flexibility Act that says shall use at least 60% and may use up to 40% of such amount. So that question we had earlier about, do you have to even consider the other uses if you use it all for payroll? I'd say it seems pretty clear that you don't have to, because you may use up to 40%, but you shall use it at least 60. So I think that kind of clears up that piece. Hopefully this won't be too big of a problem for people, because now that you can elect 24 weeks instead of 8 weeks and your loan size did not grow, it would make it easier, hypothetically, to have your payroll costs reach that 60% threshold, because now you've tripled that time frame in which you have to spend that money on payroll. So hopefully that won't be an issue. All right. The next piece is the wage reduction. Wage reduction is literally the wages of your employees. So you're comparing the hourly and salary wages of your employees in your covered period to the period prior to when all of this happened. So that January to March period. And there's some other periods that you can compare things to. I know that seasonal employees have some room, and there's other periods, and your lender and your accountants should be able to help you pick which periods are the best when you're electing. But generally, just for brevity's sake, we'll say that you're comparing the covered period to this period right before everything happened. Generally, it excludes reductions for employees that were making more than 100K. That's because they literally prohibited you from paying out more than 100K annualized over the covered period. So they're not also going to penalize you from reducing someone's salary to that 100K. So if someone was 110K, but you've only been paying them what their salary is annualized at 100K, you're not going to be hit for that reduction. So that's important. All right, so the calculation is a little different for both hourly and salary employees. So for hourly employees, this doesn't have to do with the amount of hours they work. Now that will affect your employee numbers, but that doesn't have anything to do with the wage reduction piece. And what I mean by that is if you have an hourly employee who's paid $10 an hour and you reduce them to $9 an hour over this, you're okay, because that wasn't a 25% reduction or more, so that won't be held against you for forgiveness. Now, if they were paid $10 an hour in that prior period, and now you're only paying them $5 an hour, you will have a reduction in forgiveness, because now you are only paying them half of what you paid them previously. So that would be problematic from that sake. But this doesn't have to do with the amount of hours they work necessarily. This piece, this wage piece, only has to do with what you're paying them for those hours worked. Now, salary does come across a little bit easier. As we said, it's the max is 100K annualized to that covered period. If you reduce them to 100K, you're A-okay. If they were at 100K and you reduce them to 75K, you're still okay, no penalty. But as soon as you're at 74K, that would be a reduction that is flagged for them, and that would be held against you. Now, if you're looking at these slides, we talk about the calculation being the reduction is the excess of 25% multiplied by 8 weeks. That's because initially the covered period was 8 weeks. This calculation is going to change based on the period that you elected, but we'll keep this here just kind of as a general math way to go about it. But you should adjust it depending on the covered period that you pick. So that's just the wage reduction piece. There is a safe harbor, which is great. This changed with the Flexibility Act. It used to be a safe harbor that ended in June, but they've extended it all the way to the end of the year, to December 31st, 2020. So you're going to compare for wages only, so don't confuse this with the employee numbers, but you're going to compare the annual wages in your covered period to what your average was prior to that February 15th time that we keep talking about. So this is very similar to the safe harbor for the FTE reduction, but basically, if, as we were talking, you had an employee who made 100K, you reduce them to 74K annualized over that period. If you have bumped their salary back up so they're making exactly what they were supposed to, by December 31st, then you no longer have a reduction, and you will no longer have, even if you had that reduction previously, that won't be held against you now. So that's really important. And since they gave you such a long time frame to encapsulate the changes in those wages, that's super important. Now, if somebody was reduced previously and you have now got them back to normal, before you apply for forgiveness, it's best practices to make sure that your payroll documents that you're submitting as support include that your wages are back to normal. So don't apply for forgiveness. It's probably not best practices anyway to apply for forgiveness until you've remedied all those reductions. That goes for wages and employees, but specifically for wages right now, you have until December 31st to get them back to normal. So take that time to do so you can get the full forgiveness. Now we're on to the employee numbers. So this has changed a little bit. Originally, people were making their employee numbers off of whatever their full-time work week was. So that might have been 37.5 hours and not 40 hours. And they have clearly said now that a full-time equivalent employee is 40 hours. So that could change your numbers a little bit. There's a couple ways you can calculate what a full-time employee is, but simply if they are 40 hours, then that's a one full-time employee. And if they're under 40 hours, then they're a 0.5, and add them together. Now, this might sound alarming because this could have changed your numbers from what you applied for. So figure out how this might change your numbers, so that way when you apply for forgiveness, you can discuss with your lender that you had applied based on what the directions were at the time, what the law was at the time. And now that the regulations have changed, your numbers have changed, but not because you did something inaccurate in the beginning, but just because the regulations changed over time. And just be very clear about it. I don't think they're going to hold it against you, but you should adjust your calculations so you have an idea. So you're not comparing what your new calculation would be at 40 hours to what your old calculation was at 37.5, because back when you did it, you thought your 37.5 was a full-time employee, but now you might have thought, hey, the employee wouldn't be a full employee because they're not working 40 hours. So you're going to want to kind of figure those numbers out. I see more questions coming in, and I promise we'll get to them. I just want to get through these slides to kind of summarize this up. So there's a safe harbor. There's a couple safe harbors now for FTEs. If you had a reduction in numbers and you couldn't bring people back, I know that was a huge concern, especially because unemployment was, so high and people were worried about people not wanting to return to their jobs. They've made it clearer in this Flexibility Act. So with the Act plus the regulations, if you can document an inability to rehire individuals who were your employees on February 15th, 2020, and an inability to hire similarly qualified employees, then that reduction in numbers won't be held against you. So if Sally was your employee in February 1st, but you had to lay people off in, March 31st, and you tried to hire her back when you got this loan in April 1st, and she said, I'm not coming back, That won't be held against you if you can document, and we suggest in writing. So make your offers in writing, try to get the refusal in writing so you have something tangible to put in with your forgiveness application. But they won't hold the fact that she wouldn't come back against you if you made that offer. And you also have to show that you did try to hire someone to replace Sally, say. And if Sally's replacement, you can't find anybody who has her similar qualifications, show that you did that, and they won't hold that against you either. So that's really important. And I think that helps. That's very pro borrower, because it hopefully will help people not get hurt when they tried to hire people back, but it was out of their control whether or not they could bring them back. The other piece is they have made this very broad and a little bit hard to figure out how you document this. But if you were unable to return to the same level of business activity as you were operating prior to February 15th, 2020, due to the requirements, restrictions, et cetera, the Secretary of Health, the Centers for Disease Control, Occupational Safety and Health Administration, during the period beginning March 1st, 2020 and ending December 31st, 2020. So that's really big, related to the standards set for sanitation, social distancing, or other worker or customer safety requirements related to COVID-19. This is super important. So we have a wide variety of clients, but for campgrounds, for example, a lot of you were restricted about, you couldn't do activities anymore. So you might have had a whole set of staff that you haven't hired back because you cannot do that part of your business. Well, if you can document that you couldn't do that because of these directives, they're not going to hold that against you. Again, that's what is the documentation. We don't know exactly what that would be, but whatever you can get in writing, keep track of all those restrictions. I know that you've been getting all sorts of restrictions in the mail from government and things like that to show that you literally had no use for those employees. You might not be penalized for that. Same for car dealerships. I know that you had a period where test drives, you didn't go with people, you didn't need as many salespeople, all of those things. If you can show that you couldn't have as many people working because of these restrictions, this is something you want to document, because they are intending that not be held against you, because they're the reason that you couldn't have your full-time equivalent numbers. So hopefully they won't hold that against you. So that's why we say this Flexibility Act is really borrower friendly, is because they were trying to fix all these issues that arose and not hold it against people. So there's a safe harbor for FTEs. It's very similar to the wage one. Basically, when you compare those periods, if you had a reduction in the number of employees and you got it back to normal before the end of the year, then they're not going to hold it against you. It operates the exact same way as the wage reduction was. It's the same time frame. So if you get your numbers back up before you apply for loan forgiveness, you have until the end of the year, then they will not hold that reduction of numbers against you, even if those reductions didn't fall into those other safe harbors. So that's super important. Note that we still don't know, and there's still no requirement to continue your numbers after you've applied for forgiveness and received forgiveness. So there's nothing that says that if you had to have 10 people and you applied for forgiveness and you got it, and then you had 9 people after that, that you'll be penalized in any way. Never say never. They've changed a lot, but right now there isn't anything for that. The last piece, I guess, is looking at kind of how these reductions would work. So this slide kind of shows if you had to reduce based on the numbers not being correct, because unlike the 60-40 split, you can still get some forgiveness. It'll just be reduced if your numbers are off. So if you had 150K in eligible expenses, so payroll costs, et cetera, and your average number of people was 50, and then it got in your covered period, it was 20, that's a 60% reduction. So then your forgiveness amount is going to be reduced by that 60% reduction. So there will still be some forgiveness, it just won't be all of it. It will be reduced by your numbers. Again, you have that safe harbor to get your numbers back up. that you now have the ability to ignore some of those numbers if you documented correctly. So hopefully, you will have the ability to get all your numbers back, and this way, this won't come up at all. Do keep in mind that although you have till December 31st to get your numbers back up, they've also put this piece in the act, the Flexibility Act, that you have to apply for forgiveness within 10 months of the end of your covered period. And if you don't, that's when you make your first payment on the loan. So depending on what covered period length you picked, this may or may not be a concern, but do just keep these new deadlines in mind. All right, so the next piece, before we move on to the application itself, let's pause and take a look at some of these questions. Right. So, Jim, would you like to answer some questions?
Yep, there's a question here. Why is it called a grant money if it's not free? It is free if you meet the terms and conditions of the grant. If you don't, you're not going to be able to get the forgiveness or the free access to the funds that were granted to you initially. I think that's pretty clear in the applications for everything, including the $10,000 grant initially that you were entitled to ask for on the EIDL. So keep in mind that it is grant money, but if you don't meet the conditions of the grant with respect to the PPP loan, it's converted to a loan. That's one thing. There's someone goes on and asks if we're going to get the slides. The slides are going to be emailed to everybody. We have your email addresses. We'll email a set of slides to you afterwards. Let's see. I have an employee or employees that would not return to work and collected unemployment. If I had employees on unemployment before receiving the PPP loan, will this disqualify me for loan forgiveness? Oh, interesting. No, I think it's going to depend on your numbers, the calculus in your numbers, which again just got more generous with respect to dropping from the SBA's 75% determination to the new 60%. Just as a digression, we've all struggled with the SBA regulations and re-regulations as they try to sort things out. Remember, it's Congress that enacts laws, and the various federal agencies are authorized to issue regulations on their interpretations of how those laws are to be utilized and enforced and interpreted. Best example I can give you, in the original SBA regulation, it seemed to me that they put 10 different attorneys in 10 different rooms and asked them to come up with what the regs would be with respect to whether or not independent contractors or subcontractors could be included in your calculus for payroll. If you have the interest and want to pull your hair out, you can go back and look. I think it's page 14 or 18 of the regulations. It specifically stated in one subsection that they were not to be included, and then immediate next subsection said, was addressed, calculating your payroll cost. Include your actual payroll together with payments made to contractors and subcontractors. Those two conflicting statements were within less than a half an inch of each other. And that's been one of the problems. That's why the Flexibility Act was designed to clean up some of these issues where the SBA clearly had gone too far or had left too much confusion. I view it a lot if they went too far. Not to politicize this, but everybody patted themselves on the back with a great effort in a short period of time to get some help out to private industry to keep the economy going. And at that point in time, the SBA sat around and said, whoa, they want to put the brakes on this, and some of the brakes that they put on are not authorized nor envisioned. So I don't know if that helps at all. Would a company need to plan a partial payroll? We talked about this. I guess Colin or Chris, if you could read this as well, but my initial reaction is, because we debated it, quite frankly, in our law firm. If your pay period goes retroactively, either 1 or 2 weeks back, if it's paid, so let's say your money arrived on a Monday, and on Friday you issued a payroll for the previous 2 weeks. Only one of those weeks was included in earned or incurred within the receipt of the money, but in fact, that is your normal pay. So if you now go to the end of your 8 weeks or now 24 weeks, you're going to have the same problem. You're going to move those dates one way or another. So you're either going to capture the extra week at the beginning or you're going to capture it at the end. I think that's the way I have assessed it, but
So they dealt with this in the interim regulations by creating an 8-week alternate covered period. However, it's not clear following the passing of the Flexibility Act and the enlargement of the covered period exactly how they're going to address it now. So keep an eye on the regulations on that point. I think they're going to address it because I think they have to.
with respect to the issue of employees who refuse to come back, obviously the Flexibility Act has given you some specific guidance in that regard. Before you were relegated to offering your employee the job back, if they said no, your obligation under the labor laws would be to immediately report that individual as being unqualified to continue to receive unemployment. Obviously, there are a number of employees who, quite frankly, are better off with a $600 per week kicker from the federal government to be out on unemployment than they would be if they were brought back and had to work for the same or actually a lesser amount of money. But that's all been pretty well clarified now. You get to exclude those individuals who are offered their position back and don't take it back, and you are unable to find a comparable person for the comparable position. So they're dropped from the calculation.
I'm going to jump in quick and answer some of these quicker ones. So for clarity about that 7K EIDL grant, how do you pay it back? You're not paying it back as much as you're noting it on your forgiveness application, which we'll kind of get into in this next section. So they will take that from your loan amount overall. So if you had, say, a 10K PPP loan, but you got a 7K grant, they're only going to forgive 3K of that 10K loan because you had gotten that 7K grant. So they're going to make you pay back the rest of that 7K as a loan. And those loan terms that they've discussed, what would happen if you didn't get forgiveness, that's what's going to happen to that extra piece. So that's how they're accounting for it, because they don't want to give you free money twice, is kind of why they did that. And then another short one, let's see. For regarding a wage reduction safe harbor, do you have to make up for the shortage that was paid, or do you just have to start paying their old wage from now on? That's a great question. You just have to you don't have to make up what you didn't pay them during that time period. You just have to start paying them their old wage. So if you had not been paying them 5K that they had technically gotten previously, you're not in arrears with them. You just have to start paying the new wage moving forward, which is why the payroll documents you use when you apply for forgiveness, you want to make sure they encapsulate that period where you bring them back to that regular salary or hourly rate or whatever it is. So it doesn't matter that you pay them reduced previously if you start paying them now, and there's no obligation as far as currently to make up for that time you didn't. Now, some businesses are, because that's just the relationship they have with their employees, but there's no legal obligation to do so right now.
There's a question on clock rate versus flag rate for technicians. Make it very simple. It's hours on the premises. Your clock rate is not, I don't even see any benefit unless they were there for 20 hours a week and they were booking 40 hours a week on the clock that you want to consider them full-time. I can almost assure you that the government is not going to consider the billable time versus the actual time on the premises. So, Colin, Chrissy, you have any thoughts on that?
No.
No, I think that's good. Another quick one we can answer. Do you count overtime rates for the average hourly base rate? That's kind of a rough one. You can't count an employee twice if you're over 40 hours. I don't know, Colin or Jib, do you know if they address overtime rates for the calculation?
So my read of that question is that they are looking for guidance on wage reduction. So I could be reading the question wrong, but my read is that they're asking if it gets reduced. Does that count as a wage reduction if someone goes from having a big chunk of OT to not having OT? I would think not, that would not be held against you. But I don't believe there's guidance on that point. Does anyone differ on that?
No.
No. Colin, when I have you, do you know if the Flexibility Act changed the qualifications for total headcount? I guess I think.
Well, insofar as it allowed, well, first of all, the 40-hour number came from the interim rulemaking. Then the only way the Flexibility Act impacted headcount issues like FTE requirements is that it gave you several avenues by which you could not count people who you can't bring back in a permissible way that without damaging your eligibility for forgiveness. So that's the major contribution from the Flexibility Act. The 40-hour definition and other FTE stuff came from regulations, which, there's always a chance that post Flexibility Act we'll see new regulations. So keep your eye out for that.
So Colin, actually, that's a good segue to this last question before moving on to the next section. We had our CFO retire in early March, which is something we staffed up for years in advance in preparation. So this was someone that was going to leave non-pandemic related. Since he retired and we didn't have to hire anyone else to replace him, are we going to be penalized on that FTE reduction?
No, pursuant to the most recent interim rulemaking, that could be considered a voluntary resignation, though it's called a retirement. This person. So I would document that and present it as a voluntary resignation, which pursuant to the most recent rulemaking does not affect your FTE count.
Talking about voluntary resignations, discussion earlier, you have an individual who's not performing clearly, and you're going to terminate this individual. I think, Colin, dispute me if you do, that if you can get the person to resign, you've got a better prophylactic than trying to prove that the individual was terminated for cause and therefore should be calculated.
I think you're okay both ways. I mean, it's harder to terminate for cause under a union contract for sure. So that might leave you up in the air. If you can, I guess ideally a voluntary resignation and termination for cause are two scenarios the rulemaking sets forth will not be held against you for FTE. But again, I'd be a little careful on this because I just have a feeling that post-Flexibility Act, which created this new business effect rule with regard to FTE count, that we're going to see more new regulations on this. But in the short term, I would say for cause certainly helps protect the reputation by not terminating for cause. You help the reputation of the individual. And you are equivalent to a voluntary resignation at this point. So based on the interim regulations, if all things are considered equal, voluntary resignation is a good way to handle this because it helps the individual and it still achieves your goal of not impacting your FTE count.
Well, the reason I bring that up is because having done a number of hearings for clients in the last several years, what you consider a termination for cause, Unemployment Insurance Division is pretty strident about coming back at you and say, did they receive written notification? How many did they receive? Did they receive counseling? And all of those things are so subjective that if you can get a termination by resignation, I think your life will be easier.
I agree with that.
All right. So that gets us through those questions. So I'm going to continue with the next piece and then we'll take some more questions after that. Okay, so now we are on to the forgiveness application. Now, granted, this application actually came out before the Flexibility Act, so this form is likely to change to incorporate some of the new things we've been talking about. However, as of this morning, when I checked the SBA website, it had not updated. So keep an eye out for that. I think that it will change, but I think the general premises will stay the same. So this should still be helpful. So when you get these slides, this is kind of what the loan application looks like. And this is a clickable link. So you will be able to get there if you haven't been able to find it for yourself previously. If not, you can find it on the SBA.gov website if you do some clicking through, but we put it here so it was easy for you to find. So this is called Form 3508. It's 11 pages. It's broken down into 5 separate parts. And it's kind of suggested that you work backwards. That's because the later pages in the document help you fill out the prior pages. So it's kind of some weird construction. But when you look at it, you should kind of start at the back. So it starts with the calculation form. Then comes the Schedule A. Then there's that Schedule A worksheet that helps you fill out Schedule A. Then there's a list of kind of the documents that you should submit. And then there's an optional borrower demographic information form. This is not unusual. The SBA usually gives this form with their loans. So this isn't a weird form. It's optional to fill it out. So if you want to disregard it because you're totally overwhelmed with paperwork, that's not going to hurt your application, but it's also not unusual that they asked for this. So these are kind of the 5 main parts, and I imagine they will stay the same, although the contents might shift a little to reflect the new covered periods and the new monetary amounts, but generally this form should likely stay with these 5 sections. So the kind of information you'd need to fill out these forms is you're going to need your SBA and lender loan numbers. You're going to need to know the exact amount of your loan. You probably do. You've probably been hemming and hawing about how you're using this whole time, so I'm sure you can rattle off the number right now. You're going to want to know the date your loan was dispersed, because that's that loan origination, loan disbursement that we've been talking about. So that date matters because that starts your covered period time window, whether you elected the 8 or 24 weeks, it starts on that day. So that matters. You need to know the number of employees at the time you made your application. So that's when we talked about the possible discrepancies. So this is kind of the part where that would be highlighted. And then the number of employees, the full-time equivalent employees you have when you're making this application for forgiveness. So again, that's where you need to pay attention to that 40-hour work week versus what you might have done previously. The payroll number, so did you make that 60% threshold? Did you use 100% of it payroll? However you use that for payroll, make sure that you have the documents supporting that, whether that's a 941 or other documents, depending on how you pay people, talk to your accountant, but make sure you have documentary proof that you use those for payrolls. So you need to know the dates of your covered period. I apologize, there's an error on this slide. At the time when we originally put these together, there was an alternative period, but right now there's only the covered period. So that's going to be the 8 weeks or 24-week window that you pick. If you made mortgage interest payments, then you need to show that you made those interest payments and have documents supporting that. If you had a rent or a lease, have that lease, have canceled checks, have bank statements that show that you made that lease payment every month or whenever you make that payment. If you used utility payments, make sure you have those bills. And then again, a canceled check or a bank statement showing you paid that bill. If you got that EDIL grant, as we've been discussing, they ask for the amount of that grant and the loan number for that. So this is where that comes in. Definitely can't hide that from that. They are asking for it. The best practice is to have as much documentation as possible for all of this. I know it sounds like you're putting together a lot of paperwork, but the more complete your paper trail is for what you did with the funds, the easier it will be for both your lender and the SBA to assess whether or not you should be granted for forgiveness. So do make sure you put together anything you have that shows how you use the funds appropriately. So all of that's super important. So you have all that information, and then you're going to start putting things on the worksheet and then eventually into Schedule A. That's going to be things like the contributions you made for health insurance. I know we had a question about that. The contributions you made for retirement plans, the contributions or the amounts you paid towards state and local taxes, compensation to owners specifically. That's where that whole owner-employee thing might change because it was capped at different amounts and across all businesses. And so maybe it before was that 15,385 across all businesses. If they extended over that 24-week period, that could get increased to 46K and some change. So keep an eye out on that piece. That might have some flexibility moving forward. And then your average number, again, of full-time equivalent employees during one of those time periods that you picked. It's the general 2. Seasonal businesses have another alternative period. This is kind of where you elect those periods. So that's kind of a general overview of the form as it was prior to the Flexibility Act. You can look at it, it's still there. I think the general premises will stay the same, but as of right now, we don't know if it will be exactly this form when you apply for loan forgiveness, because the Flexibility Act just came out, I guess that was midweek last week. So they've been a little slow, I guess, on updating their guidance, their regulations, and their forms on the SBA website. So I would just keep checking back there to see if they changed the form. But I imagine it will be very similar to the one we have now, because that will generally still be the information they're asking for. The instructions might change and the numbers might change a little bit. But I think this will be generally what they're still looking for. And again, as Colin had said in the very beginning, as a harken back to that, there is that box about whether your loan is over 2 million or more. So be very careful not to check that. I know a little bit of us go form blind when we're looking at it, but please don't do that to yourself and miss that box entirely if it doesn't apply to you. So that way you don't flag yourself for any further review. Now, before we move on to the next section, let's just take a look at some more questions. Let's see. Our group life insurance premiums qualify a qualified payroll expense?
I believe so. I'm not sure. Chrissy, do you have the answer to that?
Group life insurance premiums, qualified payroll expense. I lean towards yes on that. I don't know, Jim, if you have another piece. They generally said that the employer part of contributions for life insurance, health insurance, etc., would be counted as a payroll expense. So I'm leaning towards yes. I haven't seen life insurance itself come up in one of these. They usually have been focusing on the health insurance piece. But if you have a practice as part of your payroll, as paying life insurance premiums for your employees, then I think that you would have a chance of saying that's a payroll expense. I'd try to use it up on the things that are more certain first. But if you're grasping at straws to try to make that 60% threshold, I don't think it's a bad place to try. But I would definitely attempt to do the other things before you did that. So I'd say
I would look at that, Chrissy. I would look at that in this fashion, the same way as we talked about before with respect to your CAM charges on the lease. If you have a written agreement with an employee or as a part of your annual employment review, that is a component of their annual compensation. I'd say it's includable. I think you have an excellent argument to say I have a contractual obligation that's part of their employment package. If you give someone a cell phone allowance, for instance, I think you have a good argument. If you have a written agreement that requires that is in fact a term and condition of employment compensation that has to be adhered to. I would be fairly aggressive about that. But
I agree with Jim. This is this other question about operating business from home. How does mortgage and utilities work is an interesting one. I would think that you would treat it in the same way, to the extent that you write off a portion. I would think you would treat the portion that you write off as a business expense as the portion you consider to be something you would pay with PPP. Does anyone disagree with me on that?
no, I think it's includable. It's in furtherance, it's a utility charge in furtherance of the business. And since people are required for government regulation or safety purposes to work remotely, I don't know why it wouldn't be included.
Yeah, that's the next one. So one more question. I guess, Colin, this was kind of in your area. If you are a sole proprietorship, are you supposed to count yourself as an employee or not?
Yes. Yeah, I think so.
All right, perfect. All right, so next section, I believe, is Jim. So Jim, ready to take it away for additional things to think about.
There are some things to think about, and there's been great clarity been provided by the Flexibility Act, but also challenges and opportunities. One of them I would have, and keep in mind also that the regulations from the SBA and the IRS are again, their interpretation. So how do we deal with the issue of you submit your application for forgiveness and your banker comes back to you and says, you don't qualify. You didn't do this, you didn't do that. Well, if you're prior to December 31st, can you withdraw your application for forgiveness and wait until you do forgive? So earlier, someone asked about not having an employee at the time, a particular time, but might you have that person or that position filled by December 31st that would give you the FTEs you required? You may very well. That issue has not been addressed, and I assume, I'm not the only person who's thought of it, that the SBA will come up with a new set of regulations that will address those types of issues. The timing of when you apply for your forgiveness between now and December 31st is fairly critical, and you need to do some significant calculations with in-house and out-house accounting staff to make certain that when you apply, you are going to get the required forgiveness, because you now have the latitude of additional time to do that. I think one of the reasons that the additional time was granted had to do with seasonal businesses, had to do with the restaurants, but it also had to do with the issue of the banks are paid fixed fees on these, and they were jammed up so much in getting these loans out the door, working 93 hours a day, that somebody might have looked at this and said, we need a longer period of time to tail this thing off. So I think there was some component of recognition of the fact that in order to process these things accurately and correctly on the forgiveness, people needed time to do it intelligently. Please also keep in mind that your bank has a fiduciary duty to the SBA. They have a contractual relationship with the SBA to be handling these funds, and therefore they want to do it correctly. They're in a bit of a conundrum because clearly they're incentivized to approve forgiveness, because if you're a customer of that bank, that obviously makes you more creditworthy than if you had to convert your loan out to a 5-year loan with 1% interest. Certainly that's not much, but obviously they would like their borrowers and customers to be as loan-free as possible to make them more creditworthy for payment of the obligations that you may have to the bank. So there are a lot of considerations. Please make it easy for your bank by having the records accurately available and presented to them. They're paid a flat fee on these things. They've got a percentage of your loan, and that's all they're going to get. They're not going to get extra money for the consideration. So if you want to make your banker happy, make their job easy. One of the issues that I struggle with is if your company was given, let's say, $100,000 as your payroll calculation at the beginning of this loan program, when do you have to expend that money? Is it identifiable? We've been telling everybody, and certainly we did, set our money aside in a separate account so that it could be easily traceable. But if you get to the point of calculation on your forgiveness and you're not hitting the 60/40 for whatever reason, are you allowed to just continue paying as you normally would in the normal course of business between now and December 31st, your continued payroll, and those funds, although not directly coming out of the account that you set aside because that's been exhausted for whatever reason, are you allowed to include payroll paid subsequently? I think you are, but it's not particularly clear whether or not the government is going to faithfully consider those funds as fungible, that payroll is payroll, regardless of what generated the payroll during the period in question prior to the time that you asked for forgiveness. So please keep in mind, these are moving targets. And if you get it all close to any of the standards for forgiveness, you really need to look back, call us, talk to your accountants, talk to your attorneys, make sure you understand how you may leapfrog up to the level of forgiveness that you need of the 60% in order to get that guaranteed forgiveness. The other issue Colin talked about early on was one that's been a bit frustrating for us because the initial CARES Act PPP loan really did indicate that there was going to be a deductible portion of the money that you were getting in your grant that you were going to be able to include as a deductible expense, even though you didn't generate the income to pay those expenses. A lot of people jumped on the fact, and at first blush, it does appear to be double dipping. But if you think about the purpose of the CARES Act and now is reimagined under the Flexibility Act, it's designed to keep money in the economy and to generate jobs and opportunities. I'm sure, like all of you, I believe 100% of everything I read. That's a joke. But I've read repeatedly that a dollar that stays in the government coffers flips in the economy. It's worth somewhere between 3.2 and 3.6%, between $3 and $3.60 in value in the economy as it rolls forward. A dollar left in private industry typically generates $11 plus in money downstream. So if you think about the fact that this whole concept was developed to keep the economy flowing, what better way to keep it flowing than to allow you to deduct your payroll expenses, because you're going to have, as a business, that money available to buy furniture, fixtures, and equipment, hire people, or whatever, and that money is going to stay in the private industry, streaming downstream more than 11 times. So if that was part of the intent, which it would appear that it was when Congress passed the CARES Act, then it was the IRS came in with their typical, understandable determination that you would not be able to deduct those expenses. We had all hoped that the Flexibility Act would specifically address that and overrule the IRS's interpretation. As of now, they haven't. I think to be safe, you should assume that they're not going to be deductible. But I think that hopefully people will come to their senses and say, this is a way that you can keep money in the economy, and the damage to the economy, damage to the government will be spread out over a longer period of time, and that is certainly worth it to keep so much money flowing in the economy. The forgiveness regulations have yet to be finalized, so you're going to have to wait to see what the SBA does in that regard. Initially, I said that the audit may be performed by the SBA or the IRS. That is some rumor that keeps bouncing around. The SBA actually does not have the staff to audit, that I can tell or understand, even the loans above $2 million. And the IRS is typically the agency that has the staff available to do that. And so I would assume that you're going to be visited either by an SBA audit team or an IRS audit team, but that's not certain at this time. What else do we got?
All right, so I think now would be a good time to remind everyone to get their questions in right now if you have them. We don't want to take up too much of your day, but again, you can use that little Q&A button to get a question in right now in case about any of the things we did preceding, even if you missed previous one, so feel free to put it down there. Jim, Colin, anyone, we currently have one question. It says that they have many part-time employees who work anywhere from 5 hours a week to 30 hours a week. Is there a formula for converting part-time employees to full-time, or do you just consider them a 0.5 if they're not a full-time employee? And I think
we're going to kick that back to you, Chrissy, since you want to slide on that.
So perfect. So I think that some of that is generally you can elect one of two equations, and part of this you should have already done before you applied for the loan, because you're comparing to the number that you applied with. So whatever calculation you used in the beginning is probably the calculation you want to first reflect on now, because otherwise it might screw you all up for comparing those two periods. Because if we completely change your numbers now based off of a different calculation, then you're going to have a hard time matching up to that previous number. So I'd first start to look what you did previously. That's most important. The next piece, as you'd see in the slides that we'll email out later, there tends to be two ways to calculate this. Some just 0.5 people for everyone. That both helps and hurts you in this case. If you 0.5 a 5-hour employee, that makes them worth more. But if you 0.5 to 30-hour employee, that kind of makes them worth less. So if you're fancy in the math department, you can get a little more in the nitty gritty and figure out what 5 hours is of 40 hours and what 30 hours is of 40 hours and add those fractional numbers up together. So like, 5 being an eighth of 40 hours, et cetera. So you'd have to add up 8 5-hour employees to get 1 full-time employee. You can kind of do those calculations too. But again, I would caution and be very careful that unless you're here because you're newly applying to get the loan, then because they do still have funds, whatever you calculated your numbers on at the beginning, try to do a similar calculation at the end, because you don't want a huge discrepancy now when you're applying for forgiveness because you chose to calculate them differently. So
Chrissy,
sorry.
Yeah, go ahead, Jim.
Jim may be trying to say something. Go ahead, Jim.
Oh, what I was going to point out was one of the best examples of how the SBA is interpreting these very rigidly. As most of you know, with respect to most 401k plans, 30 hours is considered full-time employment. There are other instances where different benefits that you're obligated to provide may be down to 25 hours. Somebody works 25 hours, they're eligible for certain benefits. And yet, in this instance, they want 40 hours. I actually looked it up because I couldn't believe that federal employees were working 40 hours, but they actually are working 40 hours. So you're going to have to be as conservative as possible in your calculation in order to assure you stand the best chance of getting forgiveness, or as much forgiveness as you're eligible for. If you try to stretch or reach, I think you're going to be sadly disappointed as to the consequence. There's going to be a very conservative view of the hours.
Also, I just want to raise with you that if you did a calculation again before the 40 hours and you're now looking back and you're saying in light of the 40 hours rulemaking, that calculation is no longer correct. I'd want to make sure you raise that at the time of your seeking forgiveness, that your original FTE number was based on the following assumptions, which we utilized and explained it out as to, our definition of full-time is X. So we relied on X, and there was no rulemaking to establish what the definition of full-time was at that time. So I'd want to make sure if that person, feels that they erred in their original calculation, I want to recalculate your original FTEs and alert your lender at the time of forgiveness that your original FTEs were miscalculated, and based on the interim rulemaking, we now have X, the number's really X, and it's really the same number of people, but just so you don't, use one set of calculations for the application and another set for the forgiveness application, because that would be the most disastrous.
As we alluded to before, the converted note now goes from 2 years to 5 years with interest at 1%.
Yeah.
That's a significant change as opposed to jamming up businesses to require them to pay it back within 2 years. What else? I think that's it. We have any more?
All right, everyone, I think we've taken enough of your time today. So if you look at the slide right now that has our main line to our law firm and the 3 emails of speakers today, feel free to email us if you have any questions. I will be emailing these slides to everybody who attended today. You're more than welcome to pass them on, and good luck everybody with applying for forgiveness. Again, if you have any questions, feel free to reach out. Hopefully this Flexibility Act and any further regulations or forms we get after this will still continue to be borrower friendly. So we're really hoping for that. And I really appreciate you all joining us on your Monday. So have a great week. And again, feel free to reach out to any of us if you have any further questions. Thank you so much.
Thank you all very much.
Thank you.
Good luck.